Let me be very clear. The next few weeks could be pivotal for both XRP and Bitcoin, and what unfolds in this critical zone may define the market's direction for months to come. If you've been watching the charts, listening to analysts, or simply trying to make sense of the volatility, now is the time to pay close attention. This isn't about hype or chasing the latest pump. It's about understanding the forces at work behind two of the most watched assets in crypto and what that means for anyone holding, trading, or planning to enter the market. The patterns we're seeing, the levels being tested, and the underlying market psychology are all aligning in a way that demands both caution and insight. Ignoring this zone could mean missing key signals that separate short-term noise from strategic opportunities. To start, we need to understand why XRP and Bitcoin are moving together, yet often in nuanced ways. Bitcoin, as the market bellwether, sets the tone for risk appetite across the crypto ecosystem. Its price swings influence liquidity, investor sentiment, and even regulatory attention. XRP, on the other hand, tends to react with amplified moves when Bitcoin approaches critical thresholds. This isn't coincidental. XRP's liquidity, market structure, and institutional participation make it highly sensitive to shifts in broader crypto trends. So when Bitcoin hits a technical or psychological level, XRP traders are effectively watching two overlapping maps: the macro trend dictated by BTC and the micro trend driven by XRP-specific catalysts, such as Ripple's ongoing partnerships, legal updates, and network activity. Looking at the charts, we can identify a range that is becoming increasingly decisive. For Bitcoin, we are observing a zone where support and resistance are converging with a volume squeeze, creating a scenario where a breakout or breakdown could trigger cascading effects. XRP, meanwhile, is hovering near a historically significant level that has previously acted as a magnet for price swings. When these levels align across both assets, traders are not just reacting to numbers, they are reacting to market psychology. The question is not whether XRP or BTC will move, but how they will move in relation to each other. Correlation is key here, and understanding the subtleties can give traders a clearer edge over those merely following headlines. Beyond charts, there's another layer to consider: liquidity flows and market participants. Institutional activity, particularly from exchanges, hedge funds, and large-scale holders, can either reinforce or disrupt technical patterns. XRP has seen a gradual increase in staking, cross-border transaction activity, and corporate adoption, which subtly affects supply dynamics. Bitcoin, meanwhile, continues to be influenced by macroeconomic data, policy announcements, and investor rotation into risk assets. Recognizing how these flows intersect is crucial for anyone trying to navigate this zone responsibly. For traders, this means paying attention not just to candlestick formations, but to order books, volume clusters, and market sentiment indicators that often precede visible price moves. Understanding these dynamics sets the stage for the next critical consideration: timing and risk management. We're not talking about predicting exact tops or bottoms. No one can do that consistently, but about positioning oneself to respond intelligently when the market signals a shift. Traders who treat this zone as a high-stakes informational environment rather than a gambling ground are more likely to see patterns emerge early and act in a measured, strategic way. This involves defining entry and exit points, monitoring overlapping support and resistance, and maintaining awareness of broader market triggers. Part 1 establishes the foundation. The critical zone matters because it is where psychology, technical levels, liquidity, and macro trends converge. Understanding these elements is the first step in seeing the bigger picture, not just chasing short-term volatility. The market is sending signals, and attentive traders can interpret them before the noise takes over. Respected viewers, as we move deeper into this analysis, it's important to break down the technical landscape in practical terms. For Bitcoin, the critical zone we're monitoring isn't just a random cluster of numbers. It's defined by multiple layers of confluence. We see long-term moving averages, prior swing highs, and psychological round numbers all intersecting, creating what traders call a decision zone. When an asset reaches such an area, it's not uncommon to see rapid accelerations in either direction, often accompanied by spikes in volume and volatility. XRP, while smaller in market capitalization, behaves similarly but with its own internal dynamics. The combination of these two assets hitting pivotal levels simultaneously creates a complex but interpretable pattern. The market is testing confidence at multiple scales at once. One of the most insightful ways to watch this is through correlation metrics. Historically, XRP has shown a strong, though not perfect, correlation with Bitcoin during major swings. However, what differentiates this period is that XRP's sensitivity appears amplified, meaning even small directional shifts in BTC can trigger more pronounced moves in XRP. This is partly due to concentrated liquidity and partly due to market psychology. Traders know that XRP is often the first altcoin to react sharply when Bitcoin approaches key support or resistance. Recognizing this can help traders anticipate potential flashpoints and adjust positions proactively rather than reactively. Another factor that's often overlooked is volume structure within these zones. Large volume nodes, or price levels where significant trading has historically occurred, act like magnets and barriers simultaneously. When price approaches these nodes, it tends to either stall or reverse sharply, and these reactions can cascade across correlated assets. For example, if Bitcoin encounters resistance at a major volume node, XRP may mirror the hesitation, or in some cases, overshoot as traders anticipate a breakout. Monitoring volume profiles, order book depth, and liquidity gaps in real time can provide early clues to which way the market may lean. Sentiment also plays a crucial role. While charts and volume provide the mechanical view, understanding trader psychology gives context to why moves happen and how long they might last. In the current critical zone, social sentiment, news catalysts, and speculative narratives interact with technical realities. This creates a feedback loop. Price moves spark discussion and fear or optimism, which then feeds back into trading behavior. For informed traders, separating rational responses to fundamentals from emotional overreactions can mean the difference between disciplined positioning and getting caught in volatility traps. Brings us to the nuanced interaction between short-term opportunities and long-term trends. While the critical zone can present rapid swings ideal for tactical trades, it also reflects larger macro trends that are less immediately visible. For XRP, this includes adoption milestones, legal updates, and network usage metrics that can subtly influence price trajectories. For Bitcoin, macroeconomic factors, institutional flows, and market rotations create underlying currents that either support or undermine short-term setups. Integrating these perspectives allows traders to position themselves with a more holistic understanding rather than treating each move as isolated. By combining correlation insights, volume structure, sentiment analysis, and macro context, Part 2 equips viewers to interpret the critical zone with greater clarity. This is where the logic, rather than luck, begins to define actionable understanding. Let me be very clear. Part 3 takes us into the actionable mechanics of navigating this critical zone, focusing on what traders should be watching in real time without falling prey to impulsive decisions. One of the first things to monitor is the relationship between support and resistance across both XRP and Bitcoin. These levels are not static. They shift as new market data comes in, and the speed at which price tests or breaks these levels often dictates whether the move is sustainable or a short-lived shakeout. For example, a decisive break of a key support level in Bitcoin could trigger stop-loss cascades across altcoins, including XRP, magnifying volatility within minutes. Recognizing these inflection points ahead of time requires not just technical tools but a disciplined mindset to filter signal from noise. Next, traders need to consider liquidity depth. In periods of high correlation, liquidity can act as both a stabilizing and destabilizing force. A shallow order book, combined with aggressive market orders, can exaggerate moves, causing temporary dislocations that may look like trend changes but are actually transient. Conversely, deep liquidity near a critical level can absorb selling or buying pressure, giving the market time to consolidate before deciding on direction. Understanding where these liquidity clusters exist and how they interact with open interest in futures or derivatives markets can give traders a clearer sense of potential price resilience or fragility. Another critical element is the role of institutional participation. Both XRP and Bitcoin have increasingly attracted large-scale holders whose actions are often less visible but highly influential. Large buy or sell blocks, often executed over multiple exchanges or through OTC channels, can suddenly shift supply-demand dynamics. Watching for unusual spikes in volume, sudden changes in order book depth, or unexpected market flows can provide early indications of institutional positioning, which often precedes major moves. Traders who are aware of this context can avoid being caught on the wrong side of a momentum surge. Risk management remains paramount. The critical zone is by nature a high-stakes environment where both upside and downside can accelerate quickly. Position sizing, stop-loss placement, and diversification across time frames or correlated assets are essential tools. This isn't about eliminating risk, no strategy can do that, but about structuring trades so that potential losses are controlled while remaining able to capitalize on legitimate opportunities. Many traders make the mistake of focusing solely on potential gains without accounting for the asymmetric nature of risk in volatile zones, and that's often where losses accumulate fastest. Finally, real-time monitoring and adaptability are key. The market is dynamic, and no single indicator can provide a complete picture. Traders need to synthesize chart patterns, volume signals, sentiment shifts, and macro news in real time while remaining disciplined enough to act only when their analysis aligns with a coherent strategy. Part 3 emphasizes the practical, actionable framework. Knowing the levels, understanding liquidity, observing institutional behavior, managing risk, and staying adaptable. This is the foundation for navigating the critical zone intelligently rather than reacting impulsively. Brings all these threads together and focuses on how to synthesize the information into a coherent trading strategy while maintaining perspective on the broader market. At this stage, it's crucial to remember that the critical zone is less about predicting exact price points and more about understanding conditions under which decisive moves are likely. For example, if Bitcoin begins consolidating just above a key support level while XRP simultaneously forms higher lows, we could be witnessing a subtle shift in market momentum that may set the stage for a breakout. Conversely, if both assets start testing their lower thresholds with increasing volume, the market is signaling a potential corrective phase that requires caution. Recognizing these patterns early allows traders to make calculated decisions rather than reacting emotionally. Part of this synthesis involves layering timeframes and perspectives. Short-term traders may focus on intraday patterns, such as candlestick formations, volume spikes, or order flow anomalies, while medium-term traders pay attention to daily or weekly levels that indicate sustained pressure or support. Meanwhile, long-term holders track macro developments, adoption metrics, and broader market cycles. By combining these layers, traders gain a multidimensional view of the critical zone, which helps reduce the noise and enhances clarity. For instance, seeing alignment between short-term technical signals and longer-term macro trends can provide stronger conviction for potential entries or exits. Another essential component is the interplay between sentiment and fundamentals. Even in technically driven markets, investor psychology can amplify moves. News events, regulatory updates, or unexpected institutional activity often act as catalysts, intensifying reactions around critical levels. Experienced traders interpret these events contextually, asking not just what happened, but how the market's reaction may influence correlated assets. For XRP, this might include monitoring Ripple network activity, legal developments, or major partnership announcements. For Bitcoin, macroeconomic data or policy shifts often ripple across altcoins. Understanding the relative weight of these factors prevents overreactions and encourages measured responses. Emphasizes disciplined execution. No matter how well you read charts or analyze flows, strategy and emotional control ultimately determine outcomes. Maintaining defined entry and exit points, sticking to predetermined risk levels, and avoiding impulsive decisions are what separate consistent performance from sporadic luck. The critical zone is a high-attention environment, and disciplined traders treat it as an opportunity to act strategically rather than chase fear or greed. By combining technical insights, liquidity awareness, sentiment interpretation, and risk discipline, you create a framework that allows for confident, informed decisions in a volatile market. Ladies and gentlemen, as we conclude, the key takeaway is this. The XRP and Bitcoin critical zone is not a mystery to be solved overnight, nor is it a place for impulsive bets. It is a convergence of technical levels, liquidity flows, market psychology, and broader macro trends that demands attention, discipline, and thoughtful analysis. Traders who approach this zone methodically, combining chart insights, volume awareness, sentiment interpretation, and rigorous risk management, position themselves to respond intelligently to whatever direction the market takes. Recognizing patterns, understanding correlations, and staying adaptable transforms uncertainty into informed opportunity. At the same time, it's important to remember that no strategy eliminates risk entirely. Markets are dynamic, and conditions can change rapidly. The advantage lies in preparation and perspective, knowing what to watch, how to interpret signals, and how to act without being driven by emotion. By doing so, traders can navigate even high-stakes environments like this critical zone with confidence and clarity, rather than being at the mercy of volatility. If this analysis helped you understand the dynamics at play and gave you a clearer view of how to approach XRP and Bitcoin in this critical period, I encourage you to like this video, subscribe to the channel for ongoing insights, and share your thoughts in the comments below. Discussing your observations and experiences is an invaluable part of learning and staying sharp in the market. The more we engage thoughtfully, the better we all become at reading and interpreting these complex yet fascinating crypto movements.